Let's talk about Elon Musk's financial empire. I mean, it is an absolute architectural marvel, right? A network of companies literally changing the world. But what if I told you that this entire incredible structure is built on a foundation of immense risk? That it's designed to be one bad day away from a complete and total collapse? Well, today we're going to deconstruct the ingenious and frankly terrifying architecture holding it all together.
To really get a sense of the scale here, let's start with this number. As of early 2026, Musk's net worth is sitting at a mind-boggling $720 billion. That's more than enough to make him the wealthiest person on the planet. But this number, as huge as it is also a clue. It points to a hidden vulnerability right at the heart of his entire empire.
And that leads us to the big paradox, the central question we're going to unpack. How on earth can the world's richest person be running an empire that is, by its very design, always just one step away from falling apart? That is the high-stakes puzzle we're diving into.
Okay, so to get a handle on the risk, you first have to understand the fuel that powers this whole machine. And for the Muskonomy, that fuel is leverage. It all kicks off with this fundamental paradox about his wealth.
So look, when you need billions of dollars to, buy a social media company or something, you've got a choice. You could sell your stock. That gets you the cash, but then you get slammed with a monster of a tax bill. Or you can do what Musk does. You pledge your stock as collateral for a loan. You get the cash you need instantly, and there's no immediate tax hit. It is a way more efficient method for unlocking the value of what you own.
And this chart right here shows you exactly what that choice leads to. Musk's wealth isn't some giant swimming pool of money he can just dive into. Almost all of it, basically the whole thing, is tied up in the stock of his companies. See that tiny sliver? Less than 1% is liquid cash. He is the textbook definition of asset-rich, cash-poor. His fortune is on paper, not in the bank.
And this gets us to the key building block of his whole empire, leverage. Put simply, it's using borrowed money to build bigger things. In Musk's case, he uses his massive stock holdings to get massive loans. And that strategy is what lets him fund new companies and expand his empire. But it also amplifies not just the potential gains, but, as we're about to see, the potential risks. Now, here's where it gets really interesting, because this strategy has a major danger baked right into it. We need to look at the financial tripwire known as a margin call. This is the mechanism that keeps this whole incredible structure perpetually teetering on a knife's edge.
So here's how it works. It's actually a pretty simple three-step process. First, Musk pledges a huge chunk of his Tesla stock to a bank as collateral for a loan. Simple enough. Second, the stock market takes a nosedive, and the value of that collateral, it drops a lot. And third, that's when the phone rings. The bank makes the call. They demand more cash right now, or they are going to be forced to sell his shares on the open market to cover their loan.
And to make this real, here are the numbers. Musk has about 236 million Tesla shares pledged, worth around $100 billion. But the number to watch, the critical one, is the threshold. Analysts figure that if Tesla's stock price drops to around $130 a share, that could trigger those margin calls. That price isn't just a number. It's the red line for the entire empire.
And hey, don't just take my word for it. Tesla themselves called out this very risk in their own annual filing. They straight up warned that a forced sell-off could create a downward spiral. So this isn't some wild theory. It's a systemic risk the company itself is reporting to its own shareholders.
And the scary part is, this is not just a theoretical danger. We have seen this exact scenario play out in the real world. And believe me, the results can be absolutely catastrophic.
Just look at the collapse of Archegos Capital back in 2021. This was a hugely leveraged fund. Its main investment started to drop in price, and boom, the margin calls came flooding in. They had to liquidate everything, which sent a massive shockwave through the market. The founder, Bill Huang, lost an unbelievable $20 billion in just 2 days. That is how fast and how brutal a margin call collapse can be.
This right here is that downward spiral Tesla was talking about. It's a vicious cycle, a snowball effect. A forced sale pushes the stock price down. That lower price then triggers another margin call from another lender, which forces more selling, which pushes the price down even further. It's a feedback loop that can wipe out billions or even tens of billions almost overnight.
So, knowing this massive risk is always hanging over his head, especially with a mountain of debt from buying X, what does Musk do? Well, he deploys a very, very sophisticated defense. It's a masterclass in corporate structuring designed to isolate these kinds of threats. So here was the strategic puzzle he had to solve. He wanted to combine his AI company, xAI, with X, the social media platform. But X was saddled with over $13 billion in debt from its acquisition. So the question was, how do you merge those two without letting all that debt and legal risk contaminate your most valuable, most important private asset, your crown jewel, SpaceX? The solution was this really elegant piece of financial engineering known as a triangular merger. Instead of having SpaceX just absorb xAI and all of its financial baggage, he structured it so xAI became a wholly owned subsidiary. The end result is a corporate firewall. xAI gets to be part of the SpaceX family, but all of its debt and its legal headaches are kept locked in their own room, totally separate from SpaceX's clean balance sheet. And this one move was a huge win strategically. It isolated that massive $13 billion debt load. It cleverly sidestepped clauses that would have forced him to repay that debt immediately. It built that legal firewall protecting SpaceX from any of X's problems. And as a nice little bonus for shareholders, the all-stock deal meant they didn't have to pay taxes on it. It was a seriously powerful defensive play. And all of this brings us to the final picture, the grand design. What you realize is that this isn't just a collection of separate companies that one guy happens to own. No, this has been engineered to be a single, interconnected financial ecosystem. The grand strategy is to create one unified Muskonomy. It's an integrated system where the best stuff, the technology, the talent, the data, can all be shared and pooled across all the companies. But at the same time, the most dangerous parts, the financial and legal risks, are carefully, surgically compartmentalized. They're locked away in these little silos. You can really visualize the whole empire as having these three core pillars. First, you've got the hardware and infrastructure layer. That's your rockets, your cars, your tunnels. Then you have the data and intelligence layer, social media data, AI models, brain-computer interfaces. And then the third pillar, the one holding it all together, is the financial engine, the whole system built on leverage and pledging stock that funds the entire enterprise. Which brings us right back to where we started. So what are we really looking at here? Is this incredibly complex, highly leveraged architecture just a fragile house of cards ready to be blown over by one bad day on the stock market, or is it something else? Is it a brilliant, if risky blueprint for a totally new kind of 21st century empire, one built not on cash, but on the strategic management of risk itself? That, right there, is the multi-trillion-dollar question.